Hi there. This is Lane Jones, Chief Investment Officer over at Evensky and Katz, Fullest Financial Wealth Management. Today we're doing sort of a repeat of a presentation we gave earlier in the quarter. I probably ran about 45 minutes an hour with questions from the audience, but I will do my best to abridge this and make it somewhat digestible for somebody potentially watching it online. So the topic of today, jumping right in, is what I really enjoy. It's just sort of looking at what I call random ruminations, sort of things that we just see that are a little interesting out there, or random thoughts, not any sort of big picture thesis that runs through the whole presentation, but just things that I find interesting. You know, I kind of call the broad topic here return, risks, opportunities, and insight ROI. And really it's a sort of just a smattering of things that I think are kind of interesting. So it was a fun talk, and hopefully next time you can join us. But if these things work well, I'll keep trying to do presentations and sort of loop in folks that maybe are around the country. So quick topics here. I'll cover sort of the idea of the investing weatherman, sort of how we think about markets. I'll talk a little bit about the Fed and what I think is one of the most dominant sort of macroeconomic things going on right now. We'll look for maybe where there's some value in the world, international markets, etc. And then a couple just kind of things that I think are interesting. You know, the safety trade. Safety is expensive. There's been a lot of talk about healthcare. Just some sort of quick pointers there. Let's hop right in. The idea of the investing weatherman. This is very much how I see the world investment landscape from a professional sense, and even from, you know, how a retail investor or somebody just trying to sort of make their way by investing for retirement would look at the world. And quite simply, you know, the world is made up of a lot of different trade winds, currents, Gulf streams, you know, jet streams, all these various things that sort of are somewhat predictable in the big picture. You know, we know that there's a Gulf Stream that runs around Florida, runs up to there. You know, there's this conveyor belt in the Atlantic. We know that there's trade winds that, you know, brought people over from Europe, etc. On the whole, I think people put way too much faith in investing meteorology, and they look for a very accurate meteorologist, which I think just generally is not really the way to approach investing. Because when you get into the real detail of things, this is a map of the east coast of the United States, and you can see that despite those very big picture, you know, currents that are running one way, the truth is that they all really have a lot of very complex ebbs and flows and nuance, and a current that maybe was running up the coast of Florida and out here into the Atlantic can easily run into something that shoves it right back up the coast. So I bring this up because I think even in my last letter that I wrote, I talked a lot about how I see the economic world, which ultimately impacts the investing world, as a place where winds and currents and crosswinds and cross currents all can shift dramatically and alter the consensus outcome or the consensus view. So it is never wise to sort of move large swaths of money based on conviction in a certain future outcome. You know, the classic example, or one of them, was that ultimately, you know, the Fed and the central governments around the world, as a result of the crisis, were printing money left and right, and that should cause rampant inflation and therefore go buy gold. Right? Well, we saw that was absolutely not a trade that worked very well, because there was no inflation and hasn't been any inflation for a variety of reasons, which, you know, I won't go into. But anytime you are an investor, there are some big picture, I'll go back, there are some big picture things you can generally rely on. Stocks should outperform bonds. That's not a prediction because of meteorology. That's simply there's a basic fundamental thing working in the world that is a reason why stocks outperform bonds. They're riskier. People are putting sweat equity and technology and time together to create profit where there was none, and that ultimately is why stocks outperform bonds. So big picture things I think you count on. It's when you get too focused on the little cross currents that you're trying to predict that really cause trouble. And it's why we often describe sort of an asset allocation as the most important decision. You know, how much is in bond, how much is in stock, ultimately is the biggest determinant of how you will do. And then beyond that, You might make modest course corrections here or there, so finding value in things when energy was, underwater. Maybe you go buy pipelines, which is something we did. And the classic is the correction is coming. Is the fear that obviously there's a big downturn coming, and more importantly that somebody is predicting it. So therefore we're sort of fools not to get out of its way. Paul Samuelson back in the '60s, a pretty famous economist, sort of joked. The line is that economists or the stock market rather, has accurately predicted 9 of the last 5 recessions, which is it's a commonly predicting recession, and they don't necessarily materialize. I think we had one of the best examples of this very recently. We had in February of 2016, just over a year ago. If you look back, OPEC over the summer had started assaulting the U.S. energy complex, basically saying you're going to be the swing producer. Enough of us managing, how much our flow is. You guys are going to do that, and we'll put a fair number of you out of business if you think that we're just going to let you run in and take market share, et cetera. As fracking in the whole U.S. energy complex is really coming of age. And as a result, we had sub $30 oil, and probably at the time, they expected maybe a third of the U.S. energy business would be put out of business if this continued for much longer. At the same time, China's had been devaluing currency, and their economics numbers were starting to decline. And as a result, the world stock market was down double digits in just 6 weeks of 2016. I think it was down 12 to 13%. This is sort of the Harry Dents of the world. This is the classic sort of I told you it was coming. It's coming to roost finally. Get out of the way of what is an overpriced market, and it's all happening right in front of your eyes. And what of course do we know happened, right? This is sort of another slide. What we know is that the market turned tail right in mid-February of 2016 and promptly went up 20+% over the next year and a quarter. So at the time when everybody's running for the excess and everything looks dour, we get a market that probably gives people the equivalent of 2 to 3 years worth of stock market gains in the span of a year. It is a classic example why you cannot simply miss the good times and sort of wait for confirmation, because markets move swiftly and they give you years worth of return in short bursts. The classic example of that, a couple steps, is this is the Dow Bar study, which says, over here, they looked at the 20-year returns by asset classes. How did real estate do? U.S. stocks. How did the classic balanced portfolio do? Bonds, gold, foreign stock markets, etc. The average investor, despite investing in all these things, classically, only earned 2.1% a year. Why? Because they're making the classic investor mistakes, which is that they're fleeing from stocks when they're cheap, and they're buying stocks when they're expensive, and as a result, they lose return. This is not completely fair, which is that these are market indices. They don't have cost in them. The average investor clearly does have cost. But I think the example is a stark one, which is they call this the investor penalty, which is, this sort of difference between the 60 stock, 40 bond, and the average investor. Says, look, the behavioral problems investors face cost them money. It's a great argument for having an advisor. If there's nothing else we do, we just bring discipline to the process. So, moving right along. This is the sort of nouveau. This is sort of a new topic, actually. We're moving on to here, but Facebook, Apple, Netflix, Google. This is what they call FANG. This is the newfangled trade. This is the 4 stocks you need to own. Because these companies are obviously some of the most influential in the world. I have no doubt that these are incredible companies. They are incredible companies. So their stock prices have reflected. They've done wonderfully for investors. But, there's this argument that you just go out and buy, sort of Peter Lynch, buy what you know, right? Unfortunately, the lesson in investing is that you cannot buy past performance. Google is a great example. They annualized earnings growth at 20% per year for a decade. That is hypergrowth beyond hypergrowth. Microsoft did it before them, right? Apple innovated 5 technologies. It constantly innovated in order to create earnings growth. Obviously they're a very well-run, successful company. But you can't buy this past return. They certainly have good company attributes, right? They're dominant market share people. They've got a good business model. They've got good management, etc. What my takeaway for you would be the following. I find it fascinating, and again, the topic was sort of things that I find interesting in the world, is that disruptors, quote unquote, are shortening the corporate life cycle. And I sort of say to you, all right, if we were 10 years ago, the iPhone is only about 10 years old, if you can believe that. But if we were to go back 10 years, maybe a little bit longer, you would say to yourself, BlackBerry, Research in Motion was the company that basically ran BlackBerry, and Nokia, they owned, flat out dominated market share in the mobile handset market, right? And you said, these were the FANGs. This is the Facebook, Apple, Netflix, Google. They are basically the extinct dinosaurs at this stage, right? Like they were innovated away from. So it's a great lesson on why you cannot simply look at what somebody has done, because you can't buy that past performance. And the other thing is that price is important, right? I mean, I find it fascinating that in 10 years these companies are basically extinct. There's another, a couple of examples. The most classic disruptor ever, in my opinion, is General Electric, right? This is Thomas Edison invents the light bulb. If you go back in history and you look at just how quickly the power grid in the United States was built and how fast light was in electricity, I guess, but light in general was in homes, it's amazing. I mean, talk about a disruptor of a company, and it's obviously still alive and very successful. Tesla is the same thing. At one point in time, a couple of years ago, I think that Tesla was outselling the BMW and the Mercedes in the luxury car market. Never mind what they could do to entire industries in the oil complex if anything like an electric car actually ever becomes a dominant innovation. So, next topic here. What I find is, and I apologize for going rapidly, I just want to be able to get you guys through this without taking too much time. I think the most dominant macroeconomic thing happening right now, and I label it cross your fingers because it really for me is cross your fingers, is what I'll call the great Fed escape. And that is that, coming out of the financial crisis, the Fed lowered interest rates down to zero. Bam, right here. This is the financial crisis, housing market crash. Pump as much money into the system as you possibly can. And they have basically been unable to move off of that until about just over a year ago. They've started to tick out of it here a little bit, and the projections are that, bam, we're going to go back into some maybe more, I won't call it normal, because normal, right, is out here, is up here in the fours, but starting to creep up by the end of 2019, we might finally get a normalized interest rate policy. This is exactly what I believe markets need, which is we need to remove this sort of puppet master from central banks that are intervening in free markets. I think that corporate CEOs don't know how to behave in that environment. It's had a lot of negative consequences in terms of, promoting stock buyback instead of capital expending to reinvest in businesses. And there's been a lot of sort of unintended consequences with it. But I don't blame the Fed because I think they had to do this to save sort of the economy. And I don't think they've had any real strong case to get out of it up until recently, because if you look at these things, right, look at the long-run growth rate in the U.S. Economy is only 1.5%. These commas are supposed to be decimal points because this is a European slide. But, this is 2% growth. We're used to 3% growth, in the United States. And part of it has been that there's been absolutely no inflation. Inflation 2%. Historically, that's their sort of lower threshold. So biggest thing that I think is important is, can the Fed get out of Dodge? And I will say I don't care why. I really don't care why. I mean, I guess I would care if there was runaway inflation. If that would probably be a problem. But cross your fingers. The Fed finally has a window here where growth has accelerated, it looks, or expectations of growth have accelerated, and is giving them a chance to sort of normalize interest rates. Right now we're at, they give a range, 75 basis points to 1%. I think they're very likely to move next week and raise rates up another quarter point. They expect another two hikes in 2017, and then a few more in 2018, and you get to this normal interest rate policy. I think this is very, very good for long-term healthy markets because it gets us back to a more normal operating economy without central banks and governments intervening. Why has it been like this? Well, this is the problem, which is that this is the strength of economic expansions from their prior peak. And you can see all these downturns or recessions, right? This is us in this recent, a very, very tepid recovery. This is why they can't, start taking logs off the fire because they're not out here. You can see that part of this is the depth of the recession, right? So, this is where we got back to our prior peak. And all these other recessions, we got back to our prior peak in here. So some of it's the length of the recession, and how deep it was to get out. But even the slope of this line is, it's not, we're not coming up here on these big rapid expansions where, coming out of a recession, you get sort of advanced growth. So this has been the problem. If you look at per capita sort of like contributions to the world's economy, and also similarly, how much per capita of the production in the world does, a person take? You can see, look, the U.S. is still the dominant economy, 18 billion euros. You can see the Eurozone is at about 11, and you can see, look, China is second biggest economy. It's actually producing, in economic terms, the same amount as the Eurozone. There's an interesting, this is a very fascinating study here, which is you can see why there's this wave of populism. I mean, I don't want to get into political things, but a U.S. person is taking 55 euros, per capita, whereas a person in China is taking 8.5. This is globalization, right? This is why you can produce cheaper in China and sell back to the United States. And ultimately, if you believe that globalization is an equilibrium, this needs to come down and this needs to come up. That's a painful process that I think we're starting to see the first inklings of in a long-term move towards equilibrium. Similarly, you can see growth rates are terrible. 2% in Europe, 1.5%. In China, and India, the only place in the world with growth. And not surprisingly, you can see our interest rates. This was before this last rate cut. We're at 0.5%. Negative rates in Europe. And this is ultimately a very odd economic place. Subdued growth and very, very low interest rates. But for whatever reason, the animal spirits are back. You can call it the election. You can say, hey, just the economy is picking up. It does not matter. But these are the expectations for quarterly earnings in the S&P 500. And this enthusiasm, optimism, actual materialized growth is why the Fed is able to raise rates. So you can see this is the energy complex. This is the fall off in the energy earnings. This is the debt ceiling back in here where we almost defaulted on the S&P, and Europe went in flames with Greece, etc. So there's all these fits and starts that have happened in this recovery, which hasn't helped matters. And then, of course, the depth of just how nasty that 2008 recession was. You can see it even here. This is of the S&P 500, 300, over probably 60%, are reporting positive earnings growth surprises. And you can see some industries are having very strong earnings growth. So this is just saying, look, there are upside surprises on what people are expecting from earnings. So that's why there's, this acceleration in earnings, and hence why the Fed can get out of Dodge. So this is the big thing I look at. Can you cross your fingers? Can we get this arrow to continue, or will we get another one of these sort of false starts in growth that makes the Fed sort of sit on their hands for another year or two? A lot of people ask, is it just going to be bad for stocks? And I think this is a fascinating slide, which says this is the historical impact of Fed tightening cycles. And you can see in here that, look, we're at 75 basis points as of when this data was, and the stock market's actually done fairly well ever since this tightening cycle. And in the average of the last 5 rate hike cycles, they've raised about 3%, 300 basis points, and the S&P has done all right in it. It doesn't mean a big negative for the S&P. There are some periods in here where it was poor. This is, again, coming off that hyperinflation, back in the 80s. But I don't know that it's necessarily, if it is a slow-paced, organized, transparent Fed gradual move higher, I think we'll be all right in terms of its influence on financial markets. If it's chaotic, if there's some sort of a big picture, if rampant inflation starts happening or anything like that, then, all bets are off. But I don't know that there's a lot to fear from an organized rate hike. It might mute things for a little while, but on the whole, I don't think it's going to be terribly poor, and historically it hasn't been terribly poor. I do find this is a fascinating little factoid here, which is people talk a lot about Alan Greenspan did not do enough to diffuse the housing bubble. And I always sort of remember that in this period back here from, I think they say it was from '04 through, mid-'06, they raised interest rates 17 times. That was entirely to try to defuse a stock market, but a runaway real estate market. But the problem, not to get on too much of a tangent, but the problem is that the Chinese were buying so much of our debt because they were making so much money in trade on us that they were holding down interest rates. So despite him hiking rates constantly, he could not get the interest rates to move up to some level that might have cooled the real estate market. So just a factoid I found interesting. Let's move on. Value in the world. This is a real simple one. Currently, this is as of the end of March. The price-earnings ratio in the S&P 500 now on a forward basis, so this hasn't actually materialized, but it's about 17.5 times. To put it in some perspective, in the tech bubble, it was like 26, 27 times. Historically, the 25-year average is about 16. So 16 versus 17.5 is not this outrageously overvalued market like you hear some people predict. It's not dirt cheap, right? Dirt cheap was down here in '08, and there's some anomalies in this data, but it's not dirt cheap. But it's mildly rich in the U.S. is probably the best way I would describe it. This is the tech bubble back in here, right? You can see this was, one standard deviation. This is really out of whack. The reason people point to why the markets are dramatically overvalued is something called the Shiller PE. It is probably beyond the scope of this conversation, but I think it has some challenges in it in terms of a predictor of what markets will do. So let's look at valuations. 17 times 9.9 times earnings. This is the historical range, tech bubble. This is probably financial crisis. Average, right in here. Mildly overvalued in the U.S. In fact, the developed world is probably just a hair above its 25-year average. Europe, lower, on the whole, always cheaper in terms of its valuations because there's just less growth in Europe, but also sort of on the mark, not rich by historical standards, not cheap by historical standards. Japan is an anomaly because the Nikkei, back in 25 years ago was still wildly overvalued, and so it pushes this whole average up. But on the whole, kind of in the same place as, Europe in terms of its absolute valuation. So where do you look for potentially value? Well, you come in here and you say, look, the emerging markets you actually run on a price-to-book basis because earnings are somewhat suspect. Below, the only real place where markets are cheap relative to history is in emerging markets. Hence why if I say there's value in the world, where we would be shifting, we might be shifting a little bit of money from U.S., and this is on the margin, and moving it over to foreign markets, like Europe potentially, and the emerging markets. This is a very common trade right now, and I'm always tend to be a little skeptical about the herd mentality, but that's something that I do find is a plausible move based on valuations in the world, and something we are strongly considering. Healthcare, I'll go quickly here. This was sent to me by President of Baptist Hospital, Brian Keeley, and it's his highlights in here. But ultimately, healthcare was a big conversation not too long ago, and I'll highlight something I just think is fascinating, and I don't know has really been discussed a whole ton, which is if you look at healthcare costs, this is, I guess, looks like the New York Times. If you look at healthcare costs, they sit at 17% of the entire U.S. economy, up from 13% in '95. And you say, all right, well, maybe 1995, that was, maybe healthcare was a little bit more modest in terms of its costs back then. Germany is at 11%, up from 9%. Japan's at 10%. But China is at 5%, maybe a little worse healthcare there. But on the whole, this is just an absolute outlier in terms of a number, and it is the reason why the hands are tied completely with healthcare, which is if you said to yourself, we need to get healthcare costs under control, and you suddenly said, we're going to take them from 17 to 13. You know what that is? That 4% move there is a 4% decline in the U.S. economy. that is a recession, and that is a recession caused singularly by healthcare. Maybe there's some positive feedback loops in other places, which is, maybe corporate America spends less or consumers have more money to spend elsewhere, so therefore, maybe it has a mooted effect in terms of feedback loop. But this is the problem, that we've allowed healthcare to become too big a part of the economy that we can't rein it in without causing ourselves a recession. Just found that sort of interesting. Stock pickers versus indexers, active versus passive. This is a fascinating statistic, the SPIVA studies. It was in the Wall Street Journal at the end of the year. If you look at large company active stock managers, your Fidelity, Magellan's, pick your fund company out of the world, versus the index, just buying the market sort of indiscriminately. On a 15-year basis, 92% of large company stock managers failed to beat the index. There were 8% that did. And the problem is that if you try to find that 8%, they fall out of the category and they fall into this 92. But these are fascinating statistics, and it is the reason why there is such a wave of people moving to index products, because they're saying that these folks are just really having a hard time beating the market. And that's because I think a lot of the beating the market story has changed in the last 30 years for reasons probably beyond the scope of this. But it is a fascinating statistic, and it's why on our equity portfolio we are very, very heavily leaning towards passive approaches, and not just the super smart guy or girl that understands market better than the next guy or girl. This is another slide on the same sort of general topic, which is to say the percentage of large cap managers that outperform their index. One of the arguments is that, well, when markets get really bad, you want a person to pick stock. You don't want to own the index. So this is the percentage outperforming relative to bad markets. This is the inversion of the S&P. So here's 2008, really bad market, S&P down 40%. In that period, only 50%, half of managers outperformed. So it was a coin flip whether your guy or girl did better or worse. Even more so, look at when the market's starting to recover, the number that outperformed was down in the 20 percentile range and continued that way. Maybe you got a little bit of pop here. Such that the ultimate long-run place is 20%. Yeah, this is the problem with finding the managers, that some outperform, but then they give it back, right? Like maybe you outperform, maybe you got the right manager in this period and you avoid this 40, but you know what? They underperformed, 8 out of 10 underperformed for the rally. Anyhow. Smart beta, this is sort of a big current topic. I find it fascinating because what I think is smart beta is really just automated active management. So you used to hire Peter Lynch to look at the balance sheet of a company and sort through all the companies in the S&P, and he would say, like, this is the growth at a reasonable price. There's good growth rates here, and it's cheap by all measures relative to its industry, et cetera. Well, nowadays computers automate all of those things, and these are what we call factors. The value factor, which is the cheap factor. Quality factor, which is there's consistency in earnings growth. All these things are showing up in these indices such that now you don't buy the S&P 500, which is just blindly sort of buying by size. You can buy the S&P 500 organized by give me the cheapest pieces of the companies, value bias. Give me the highest quality companies, the S&P High Quality Index. These are things we have been doing in our portfolio for 20 years, but they're very much becoming mainstream. It's sort of a fascinating development. Another thing I find very interesting here is safety is expensive. If you look at the 10-year Treasury bond, one of the safest securities in the world by financial folks measures, you received, inflation ran about 3.25% over this long window here, and you received 6%, and that meant you got a real return of about 2.5% just on safe Treasury bonds. Nowadays, you get next to nothing. This is because safety, i.e. this very, very safe security that I want to invest in, I don't want to earn zero, but I want to earn something, has been rushed into, and there's also a lot of central bank involvement in this security, but this safety is expensive is the big problem. Bill Gross, PIMCO calls it financial repression, but it's one of the reasons you can't simply hole up and avoid taking risk, and it's one of the reasons we're sort of forced to look for new places to take risk. Another example of the safety is expensive, is consumer staples. These are the things that everybody needs regardless of whether the economy is doing well. This is not your iPad. This is, your washing machine. Your washing machine breaks, you're going out and buying a new one. Your utilities, you always need electricity, you always need power, etc. The 20-year average price-earnings ratio on staples is about 17. It's currently sitting at about 20. Same thing with utilities, 14 versus 18. So it's just another example that safety is expensive in there. You can see on the S&P 500 index as a whole, it's not nearly as wide. 16, 20-year average, 17.5 current. That's it. We had a few questions in here that I would have, were part of the presentation. I will spare you them, although they were fantastic. It was a fantastic conversation. If you have any questions about the presentation at all, please email me, ljones@ek-ff.com. It's on the website. And I thank you for joining me. If you liked it and you liked the experience or you have any feedback, please let me know. And hopefully we'll do a few more of these in the future. So thank you much for watching, and take care.